Where you pull your income from at the beginning of retirement is very subjective. It really depends on your family situation. So I have to make a lot of assumptions when I'm answering this question to the masses. Typically, in the order of financial planning, we would take money from a brokerage account first because you have maybe at worst capital gains taxes there. It could be 0% or it could be 15% depending on your income for the year. Then the next place we would go would be IRAs. We pay income tax on that, and then the last place we would go would be Roth IRA. And the reason why we go to the Roth last is with the new IRS rules, typically IRAs are going to be taxed within a 10-year period upon inheritance. So in most cases, we're spending down that money. Also, IRAs tend to be the higher account balances versus the brokerage accounts and the Roths anyway. So what we're trying to do is spend down those assets before the RMDs kick in at a later age. Now, that's like the basics. If you want to take that a step further, some people don't have pensions. They delay Social Security to age 70 as they probably should, but they retire at 60 or 65. And if they have a large brokerage account, a lot of times what we'll do is spend down money in the brokerage account first at a very low tax rate, and then we'll convert the IRA to Roth. And for most people between 60 and age 70, Social Security will kick in. You've got 10 years or maybe 5 years if you retired at 65 to do those conversions at a low tax rate. The required minimum distribution for most people now is not going to be till age 75 for the IRAs. So you actually could have 10 to 15 years of Roth conversion opportunity, depending on where in the long run your tax bracket ends up being. Now, when we do our planning, our assumption is that we are going to stay in the same tax rules today and then resetting back to the 2017 rules in 2026. So there's so many assumptions to be taken right now in financial planning in how you do this, but typically where you want to pull money from first is going to be the non-taxable money, and then transition from there to taxable, and then eventually into your Roth IRA if you ever get that far.